And welcome everybody to the 34th episode of the Hashtag Invest This podcast. I'm your host, Scott Bauer, and today we got John Casmon with us. A little bit about John. He's a marketing real estate entrepreneur who controls a portfolio worth over $18 million. He started by house hacking a duplex, now partners with investors to purchase apartment buildings through his firm, Casmon Capital Group. He's the co-creator of the Midwest Real Estate Networking Summit, a no-pitch conference to connect like-minded investors. He also hosts a monthly meetup and the weekly real estate podcast, Target Market Insights, where he speaks with specialists across the country to uncover the best emerging markets, marketing tips, and investing insights. He's got a background in marketing. He's overseen campaigns for General Motors, Nike's, Coors Light, and others. He was recognized by Black Enterprise Magazine as one of the top executives in advertising and marketing. So, John, with all that being said, why don't you give the listeners a little bit more about your background and what you're about?
Well, Scott, first of all, thanks for having me on the show. Hashtag Invest This. Love the platform. As far as my background, it's a lot of marketing, from a professional standpoint. Started off in marketing. And then as you get into the real estate front, we started, like many of your listeners, really using it as kind of a supplemental income. Started with a house hack, getting a little bit of income there. Bought kind of a 3-unit property and just kind of expanded from there. So we do a lot with real estate, love real estate. That's the passion. We really love multifamily, so I'm sure we'll talk more about that. But we have quite a few different passions there.
Definitely. So, let's start off there. I mean, when you got into your the triplex, your 3-unit to begin with,
yeah.
Did you come into that with your own money? Did you come into it with family money, or how did that work?
All of our own money. So we started, the first one's the duplex, which we, very similar to house hacking. We lived in one unit, rented out the other, and that worked really well. And essentially what happened was we created more equity than we ever anticipated, to the point where we went to the bank. We were saving up all of our own money to buy that one, as well as to buy the second triplex. And when we went to the bank, then the lender, they basically told us that we probably had enough money in that first property to refinance and get a home equity line of credit. So we had saved up close to $100K to make this second purchase, which we did. But on top of that, we actually refinanced the first one, had a pretty substantial line of credit, and that really opened us up to some different investment opportunities.
Crazy. Okay. So when was this? When did you start doing this?
We bought the duplex in 2012, and then we bought the second property in 2014. And we were just stacking all of our own money. So we just took, a portion of our income every month, put into the bank account, earning, 2.5% interest or something like that. But we just stacked it away. We just stacked a large chunk until we had enough to go out and buy another property.
So just save is kind of your strategy to start off with. But I know you don't go from saving to doing $18 million in assets under management, right? So
if you can, it's going to take a long time. But yeah, that's not exactly how we did it.
Right. So how did you do it? I mean, what was the next big purchase, or where did investors start to come into the picture for you?
Yeah, I think part of it is, that approach we were taking. We realized that it was a very slow track, right? To sit there and save that much money, it required a lot of sacrifice. It required a lot of patience. And we just knew that there had to be a faster way. I'm sitting around, I'm looking at other people I know, and I'm like, how are you doing this faster? So after starting to talk to people, we learned about other people's money, right? So OPM. And essentially, at first I was a little bit hesitant because I felt like, I don't really want to ask people for money. And then I realized, we were out here, we were making a lot of money. We were doing really well for ourselves. And we knew a lot of people who had interest in investing in real estate, but maybe didn't have the time or the energy or the knowledge to do it as well. So once we kind of shifted our position or our thinking to say, you know what, we could probably help them. They can help us. Why don't we partner together? That's really where the light bulb kind of clicked. And we started to work with investors. And we started with that with a couple smaller projects. And then we actually bought 192 units with some other partners. So we kind of all worked together to take down this property through a syndication, which is a great way to go out there, leverage not just scale, but also the professionalism and the expertise of everybody involved to go out and take down these larger deals.
Definitely. And I think it's really important one of the mindset shifts that you have to think about, and you kind of touched on it already, is going to ask people for money, because you're not necessarily asking people for money. You're asking people to participate with you in an opportunity, right?
Yep.
It's also not about taking their money. You're giving them a return. You're giving them a vehicle where they can invest their money and feel safe about it, right? In today's economy with the stocks being as fluctuating as they are. I was just on the phone with one of my coaches this last week, and he was talking about Tony Robbins just talked about, the stock market is due for a really big bust here in the very near future. So although some people would say, oh, my stock's been doing great, over the last 5 years, they've really been doing very well. My portfolio of stocks and bonds and all the things are doing better than normal. As soon as that thing busts, all of a sudden they lose everything.
Yeah.
Right?
Yeah. Yep.
With apartment buildings, on the other hand, and this is my observation. This is what I see in the market. This is what I truly believe. When the markets go down and things hit the fan, people they go to apartments, right? I mean, it's a win all the way across the board.
Yeah, that's it. You've got, that's the beauty of apartments. One, it's a real tangible asset. Stocks are great, but I'll give you one quick example. And I don't know what the numbers are now, but I remember, I think it was the first quarter, I was reading the stock reports, and Tesla, I used to work at General Motors, so I spent a lot of time at GM. So I have a pretty good understanding of the automotive industry.
Right.
And I was amazed that Tesla was actually priced above its market value or capitalization. It's higher than General Motors. Now, this is a company that has never turned a profit. And in fact, I believe the last time I saw the numbers, it lost $2 billion or something like that, something crazy. And General Motors made a $900 million profit. And yet and still, one company was very highly rated as the other was kind of mediocre. So, for me, that's the thing where they're really making a lot of gambles in the stock market. They're guessing what will happen in the future. And some of those are strategic bets. But on the same note, the thing I like about apartments is we make a little bit of strategic guess of what we can do, but we control those things, right? We're buying based off of the current operations today. And then we create a business plan. We implement that business plan, and then we can look to sell. But we have a tangible asset. So even if the market shifts or changes, we're still getting that cash flow. We're still making that money today. We're not waiting. We're not hoping. And we put ourselves in a position where we can sell when it's best for us to sell and when it's opportune. And that's really the best way you can stay afloat. If you're buying Class B, Class C apartment buildings, you can pretty much maintain even through some cycles. You might have vacancy soften up a little bit, but you can pretty much be in a strong position. So, that's the beauty of investing in apartment buildings as opposed to some of these other vehicles.
So I just had one of my investors, I think it was two weeks ago, we were talking about an apartment deal that I was working on down in Atlanta. And he was like, listen, what you're saying, it sounds almost too good to be true. Let me ask you, how do I lose all my money? How do I lose all my money? And I really couldn't give him a straight answer, because I don't find that when we're buying as conservative as we buy, and we're buying in the areas that show only positive, economic factors that are going to make the investment make sense, you're really not going to lose your money. And you can never guarantee anything, right? But I can feel very strongly that, we're not going to be putting anybody in that position, right?
Yep.
How would you answer that question? If I was going to ask you, hey, John, here's $100,000 of my money, but how do I lose it?
Well, to your point, it's going to be very difficult to lose all of it, right? Now, there is a chance I could lose some of it, but we try to mitigate all those risks. The risks that you're looking at are a couple things. One, what happens if the market absolutely tanks and my loan becomes due, right? That's one way you can lose your money. If your loan becomes due and you're in a situation, let's say it's 2008, right? You bought this property in 2003, it's now 2008, and your loan's due. You had a 5-year loan, becomes due. That's one way where you can lose if you're up, you're upside down, you don't have enough equity in the deal, things like that. So that's one way. The way to mitigate that is to either make sure you have longer debt on a property so you can make sure you can sell it when it's more opportune for yourselves, or make sure you have a value add play where you're implementing these different interior upgrades and different things like that, where you're getting the cash flow up. So if you're doing that, you're going to create more revenue. So you'll be in a better place strategically. So, I think that generally speaking, with our business plan, it's going to be tough to lose money. Sometimes you might be off on your projections as far as being able to make the returns that you're hoping for. Misunderstanding or underrepresenting what the repairs will be. That's another thing to watch out for. So those are some of the concerns I would have. But just flat out losing everything. You're buying a value add building, right? It's already there. It's already making money. You've already done your due diligence as far as the location. And to your point, Scott, if it's in an area that's growing, you're seeing job diversification. Those are things that'll be good. One thing we talk a lot about when we do our target market insights interviews with guests is, what are you looking at in the market? Because the one thing that could happen, I'll give you a good example. We just bought a 20-unit building in this area called Norwood in Cincinnati. Well, back in the 80s, General Motors moved their plant. They took it away from Norwood, and that was the main employer of that area. So what do you think happened to those apartment values and the economy in general in that area, right? So that's one big thing. If you only have one big employer, that's one way you can absolutely lose. But if you're in a place where you've done your market research, there's job diversification, you have employment growth, you have population growth, you're doing a value add play where you're going to be able to control and force appreciation, it's going to be pretty difficult to lose money if you look at those factors. So those are some key factors you want to take a look at before you make the investment. And then when you're talking to those investors, it's a much easier conversation.
Yeah, absolutely. And, let's talk about for a second, kind of the difference, A, B's, and C's. I know it sounds like we're very, very similar. When I'm going out there looking for properties, I'm looking for B's and C's. And the reason
just like school.
Right, that's exactly right. Matter of fact, I was a B student all throughout college, all throughout high school. That was my grade. So I like to be in that area, right? But
right.
The reason why I'm there is because there's so much more room for opportunity. So, for an example, here in Phoenix, I was just at an event last week where we were talking about kind of the health of the Phoenix market and what we're seeing from a broker standpoint. What's going to happen when interest rates start to tick up a little bit, what their projections are, and what they thought of what's going to happen, and in the different asset classes, right? Well, there's a ton of new A-class stuff that's going up in Phoenix. So naturally, there's more competition. They're having to give away, maybe a month's free rent or a couple months free rent, whatever it might be that way. But in the B and C stuff, that's not the case. The rent growth is still quite a bit different than in the A stuff. In the A-class buildings, there's not a whole lot more room we can go up anymore. I mean, we've been growing in rents here in Phoenix for the last, 5-7 years. I mean, it's been a long time. So those numbers are compressing. But this B and C class stuff, because not as many people are looking and working on those, they like the shiny object. There's still a ton of room for growth, which is why I still feel very safe, even here in Phoenix, which is typically a boom or bust state, right? That we have some time before things change.
Yep.
So how do you feel about it?
No, I agree completely. I mean, as you mentioned, Class A, I mean, the challenge with Class A is it's the latest and greatest. So you're always competing with new development. And I'm in Chicago, so same thing to you. We've got a ton of new development. Most of it's in the city core. And what happens with that new development, especially when you have too much new development, is you start to see the competition get there, where now you've got to start offering incentives. You've got to start softening up on your rent projections. And it's great for renters, but for an owner, you start running those issues. The other issue with Class A is that these individuals are renting by choice. So if you're paying a couple $1,000s in rent, you're doing it because you like the lifestyle, which again works if you're in a downtown urban core. But as you start to have children or start to move to a different phase of your life, then they're probably moving to a single family home. The beauty of Class B and Class C is you're now talking about more workforce housing. You're talking about people who are looking to rent because they need to. Maybe it's because they don't have the money for a down payment. Maybe they still have great credit. Maybe they're just in a transitional period of their life. But you have a bigger pool because in a Class B, you can maybe attract some of those Class A residents who are looking for a little bit of a financial break or a little bit lower rent. You may be able to get some of the Class C people who can step up a little bit as they make more money. So Class B is really good. Class C as well. If it's in the right neighborhood, Class C can work out really well as well, because these are people who are going to be either lifelong renters or long-term renters, especially if they have children, kids who are in a good school district. So they want to rent and stay in that place because of the school district. So you have a pretty good, robust group of renters. And by the way, when the economy starts to shift and change, usually they're not impacted the same way, and I know a lot of folks in Houston, in particular with the oil industry, when they start to see some changes there, those high level executives or those folks who have those, white collar jobs, they're the ones who are impacted. Those guys who, work at the fast food restaurant or, some of these other places, maybe even as a mechanic or things like that, they're not as impacted by those things, So, I mean, it's certainly ebbs and flows, and you're certainly going to see vacancies rise when the economy takes a hit. But typically, it's not going to be the same wild swings that you will see on the Class A. And then the last point is, the money, as far as the developer goes, is in building these higher end luxury condos or apartment buildings. You don't have a lot of developers building Class B or Class C product right now. So the competition is small. And those Class A products are going to be Class B products in another 10, 15 years.
Right.
So, when you look at it, you don't have as much competition from developers. And if you can take your property and do what you and I are talking about, Scott, implement a value add strategy where you can upgrade these units, make them look a little bit nicer, add some amenities or spruce some things up, you don't really have a whole lot of competition because there aren't a lot of people who are going to do that. They'd rather go out and build a brand new luxury spot that is going to compete with everybody else doing that. And then you and I are sitting here with the leftovers and the great pickings of Class B and Class C assets.
Right, right. Another thing we talked about at this event last week was the disparity between, well, I guess the need for C-class stuff and B-class stuff, because they're building and putting all their emphasis on the A-class stuff. Not everybody can afford that, to your point you said earlier. There's a lot more working class people out there than there are, top, I guess, people that can afford these more expensive units. So therefore, although gentrification is a good thing, I suppose, when it comes to, building up a city, making things a little bit nicer, it doesn't always work for everybody. And so those people that are in C-class that, they need somewhere to live. And that opens up a lot of opportunity to make those units nicer, still keep them C-class, but, you have a line out the door for people that are wanting to rent, right?
Absolutely. Yep.
Let's talk right now about the two major demographics in the U.S., the baby boomers and the millennials. Let's talk about that for a second.
Well, my background is marketing. So when it comes into market research and demographics, I spend a ton of time understanding millennials in particular, but understanding demographics. When it comes to the baby boomers, they're going through a transition in their lives where a lot of them are looking to downsize. They're looking to increase their quality of life. You see a lot moving to the warmer climates in the Southeast, the Southwest, the South in general, the West Coast. So you're seeing that happen a lot. And then with millennials, they're starting to come into their own. The older, I think I'm technically like right there at the cusp of the older millennials, right? But we're starting to settle into our careers, making good money, getting married, having kids, having those life changes. And then on the younger end, they're college graduates now and entering into the workforce and starting to earn income. So they like things a little bit different. They like the flexibility. They love to travel. They value experiences over things. So they want to make sure if they're making, let's just say if they've got an extra $1,000 a month, they want to spend that traveling or hanging out with their friends or going out to the bars or whatever the case may be. They don't necessarily want to buy stuff with it, right? These are big generalizations, but I think one of the big demographic shifts is they value things. So as investors, I think those are opportunities for us to take some of these trends, take some of these insights, and see how we can convert that into currency for us, and turn it into cultural currency where now we're tapping into the mindset a little bit more and creating an environment where we can create living experiences, right? So you have co-living that's becoming a big thing. You have micro units that's becoming a big thing in some of these places. So you can start to take advantage of some of these trends, especially if you're in a major metro. The other big thing that I've been looking at a lot is understanding, I'll call it the microwave generation, but it's the mindset of you want something, you want it right away. And you have so many social sharing apps, and I'm talking about, or even job sharing, right? You think about Uber and Uber Eats, and you have all of the food delivery and you have all the package delivery. So there's a need to have stuff Torso. So they're the car service. So you have all these things where people are looking to share as we enter into the sharing economy. I think those are other opportunities for investors or syndicators or operators or even developers to start to tap into that mindset. These individuals are looking to share stuff, right? How do you do that? How do you create opportunities for them to come in and get some value or have an amenity that maybe doesn't cost you a lot of money, but it's a new amenity that others aren't offering right now, and I think those are some things, some opportunities that could really open up the door for folks right now.
So let's talk about that as far as amenities go. The typical, if you're going to renovate a B or C class unit, what type of amenities might you put in that would be a little bit different from, everybody else, or that the millennial crew might prefer, or even the baby boomers, what they would prefer? Can you give a couple examples of that?
Yeah, I mean, the first one is, these individuals are really tech savvy on the millennial side, right? So
Right.
I get into a bit of a debate with some folks because some will say, and if you look at the research from, anyone in our industry, they will all tell you tech packages is where to go. And I agree. So things like Nest thermostats is one big thing. You have the lights that you can put on automation. You have blinds, I mean, window blinds that you can put on automation. So there are a lot of things like that from a tech standpoint that you can do. The challenge with that, or the watch out with that, is if you do it for everyone, some folks may not be as technologically advanced, and you may be causing more headaches for your property manager than anything else. So you
Right.
got to just keep that in mind and balance it a little bit. But if somebody has it and if they're willing to pay a premium for it, if they know what they're doing, that's a great advantage to have. But if you can make it kind of green, or you find ways to make it tech savvy, that can kind of help you out in the long run as well, because now you can kind of monitor whether it be heat or central air or just kind of your utility costs, and you can kind of automate some of that a little bit. Another thing is package delivery is really huge right now. So if you have either a package service or a package center, that's something that's a really big amenity right now. I would say it's probably more Class B than Class C, but if there's a way where people can get their packages securely delivered, that's something that's going to be important to a lot of renters at this point.
Now, what do you mean by that package delivery service? Obviously, Amazon is a package delivery service, comes right to your front door. Is that what you mean, or what do you mean?
So there are a couple of different layers to it, right? So one is just like when they come and drop it off. Let's say you've got this apartment building. Well, where are they dropping it? If you're in an apartment building where any Joe Schmo could walk up and take your package, that's going to be concerning, right? You've got
Right.
the safety concern there. Let's say you're in a 2 to 3 floor small to mid-rise building where there's only 6 to 8 people who can get in there. Okay, well, at least now you have a small sample set of who could have stole your package. But if there's a way to lock in that package where it's either in the front center, right? So it's in the clubhouse. That's one opportunity. But if you can create a package service where now they can go there, they have a key, they can get their packages that way. That's a big amenity. And then there's some other things now. Amazon has it where they actually have a lock where if you sign up for it, you can have it where they would get the key to your apartment and they can come in directly and deliver it inside your apartment. We haven't done that yet. I don't even know if I like that idea yet, but it is something that's available right now.
Right, right. A little questionable. I don't know if I would necessarily feel good with that, but it's something where at least if somebody enters your house, you know who it was. It's tracked who it was. If anything's missing, you can always go back to Amazon. I'm sure they would cover that. So
Exactly.
that's huge. Now we talked kind of a little bit, actually a lot now, about apartments and how they're kind of why they make sense, why we are in apartments, right? But let's go back to how you went from a duplex, triplex to 18 million assets under management. Is that the 192 units? Is that all that is comprised of? And when did that take place? Because 2014 wasn't that long ago.
No, no. So it's so I was around 2.5 million in my holdings for a long time. And again, that was all of our own personal investing.
Okay.
And what ended up happening is I realized at that point we wanted to start bringing in other investors, but I wanted to make sure I was fully knowledgeable of everything before I did that. I didn't want to take a penny from someone if I felt that I might lose that money, right? Or at least without understanding how I had been successful, right? I knew what I did was working, but sometimes you don't know why it's working. You need to kind of step back and say, okay, as we started this interview, right, you asked the question from that investor, how can I lose my money? Well, I kind of need to understand the answer to that question, right? I mean, I didn't want to go to investors and start saying, hey, come invest with me if I didn't know how I could lose your money. So we actually stepped back. And at that point, we went out and we got a coach to kind of help us understand syndication and just really capital raising in general. And that really helped us understand more of the landscape and the things that we did well as far as finding the right place to invest, as far as, making sure that there's job diversification and things like that. That really helped us get our groundwork laid out. For us, though, it's all about connecting with folks. It's not about me just running out there, calling up a broker, hey, give me that property, we'll take it down. It's relationships, right? It's all about relationships. It's all about who you know. It's all about building a network. And in short, we started building relationships with other operators, and we were all going through a similar situation where, we were looking for deals and a little tough finding deals at a certain point. I think it's starting to loosen up a little bit now, but it was really tough for a while there to find deals. And we connected with guys who've got a really good relationship. And basically, I asked them, I said, listen, if you guys find something, I'd be happy to partner with you. We've built a pretty good relationship up to this point. Love to partner with you. Sure enough, they found a deal that made sense. I took it to my investors. They were really interested in it. And we decided to partner and move forward with that deal.
It's awesome. That's phenomenal. So, we're sitting now at 18 million assets under management for you. What happens 5 years from now? What's John Casmon doing 5 years from now? What does that look like? What's your focus?
Well, I mean, this is our focus. I mean, multifamily is our focus. I think this is something that's long term. There's a lot of whisper chatter right now or noise about, the economy and where it's at and are we at the end of the cycle and things like that. I think if you buy right, you can weather the storm, as we talked about. I think if you're buying B class, C class properties, you can weather any storm. You may need to plan for a little bit more vacancy. You may need to plan to have a different type of loan product on your properties. But in general, you can withstand any of those changes. So we're going to focus here. There are other assets I get interested in to learn, but quite frankly, multifamily is kind of tried and true. People always need a place to live. They're not building that much Class B and Class C product right now. We know that there's a big affordability issue in this country. So if we can offer up products that work for these residents, and we can create an environment that is more communal and it's a place where people feel safe and comfortable and they're happy to live there, we know we're going to thrive, and we know we can cherry pick the best tenants and residents and grow our business that way. So we'll continue to do this. We'll continue to partner with other investors as well as look at other operators who are doing great things and finding the right markets to be in.
Right. And I know that we're similarly connected with a lot of good operators, other good operators that are here in the U.S. And it is all about that team. This is a team sport. I was talking recently with somebody, I don't remember where I was at exactly, but we were talking about this just being a team sport. In the single family world, a lot of stuff you can do on your own. I mean, I built a fairly large single family business by myself. But as soon as you start moving into other parts of the country, I have another property in the Midwest, you go to other areas, then you have to have a team of people, and it's a team sport. Way more fun to do deals with people than to do it by yourself. So,
Absolutely.
Happy to hear that. Now, we're kind of coming up on time here. So are you ready for a lightning round?
Let's do it.
All right. What is your hashtag invest this tip to keep our listeners moving forward?
Oh, good one. I think the biggest one I could give you is to stay aggressively patient. And what I mean by that is don't run out there and just try to do a deal just to do a deal, but take small steps every day to move forward. Just keep moving forward. Don't worry about, the big picture necessarily. I mean, that's great to know what you're striving for, but make sure you're taking steps every single day, even if that's simply looking at comps or looking at rents or looking at neighborhoods. Just do something every day that keeps you moving forward.
Absolutely. That's huge. And I'm right on that as well. I mean, you just got to never give up, keep moving forward, and you'll get to where you want to go, right? Where focus goes, energy flows.
That's right.
Do you have a favorite book?
I do. I have my favorite book is a book called The Power of Focus. It's a great book. I've had it for probably about 12 or 13 years now. And it's just a good book. I read it once a year. And it's just a good book to kind of help me lay my vision, understanding. It's what you just said, right? Where energy goes. What's the quote? Say it again.
Where focus goes, energy
Where focus goes, energy goes, right? So the power of focus, clearly I wasn't focused when you said that quote, but where focus goes, energy goes, and it's the same mindset, right? It's the ability to really focus in on something, and that's where you see huge results. And I never set out to have 18 million in real estate, and even when you say it out loud, it just sounds weird to me. Because in my mind, we didn't do that, right? I didn't build 18 million. It's like we worked with other investors and we bought a building, right? So it's just, sometimes you have to break it down in your mind so it feels like smaller steps, and then you can step back and realize, wow, you actually have achieved something pretty incredible. But it's the small steps every day that's going to get you there.
Absolutely. Great tip. Or great book, I guess, that goes with your tip even. Stay aggressive. Yeah. So, I know that we have a lot of similar coaches and mentors and people like that. Who's giving you the best advice, and what's the impact been on your life for that?
Oh, man. The best advice actually comes from a friend of mine, and actually a former boss of mine. And she said, don't lose your shine. And the point is that, this world it can chew you up a little bit there and toss you out. And it's hard to remain confident when you have things go wrong. And it's all great in sunshine, right? When things are great and you can sit up here and smile and tell the world how awesome you are as a real estate investor. But at times in life, and even outside real estate, just in life, stuff happens, right? And it's just understanding what it takes to overcome those things and being persistent and having the mental makeup to not let those things impact you too much. Take your hits, take your licks, and get up and keep going. So I think that mindset of if you've got something great, you've got a great spirit, never lose your shine and never let someone take that from you.
That's huge, man. Appreciate you sharing that. How do you like to give back? We're very blessed to be in the positions that we're in. What do you do to give back?
Yeah, so I think the biggest thing we're doing right now is we do two things. One, we're focused on real estate education, right? That's the reason we have the podcast. That's the reason we have our monthly meetups. That's the reason we do our annual conference, the Midwest Real Estate Networking Summit. So one is just real estate education. I'm a firm believer as we continue to move up the ladder, we want to bring other people along with us. The second thing is I'm a part of an organization called Search for Water. It is a great organization started by a friend of mine. And essentially what we do is we look to provide sustainable, clean water solutions across the globe. So we're actively in about 4 different countries right now. Uganda is one of those countries, the Philippines, Dominican Republic, and we're just actively out in these markets. And what we do is we not just give them clean water, we actually help them create their own sustainable solutions by, cleaning up the wells, giving them filtration systems. And we come back every few months and we check in on how these neighborhoods are going. Are the people, finding ways to continue to grow? And then obviously, if you want something to be sustainable, they've got to create their own economy. So part of what we do is we actually teach them how to make different products and things like that. And they can sell it to each other and sell it to others. And that's a way for them to start really creating their own ecosystem. So that's an organization that's just pretty amazing, man. We've got our annual conference or annual event coming up here in a couple months here. So we're excited about that too, but really love and very passionate about that organization.
Yeah, man, that's huge. And what I really like about that is the impact on the world that you have for doing that. I really appreciate you doing that. It's something that is almost intangible, but it's changing the world. You're making a big impact. When John Casmon's gone, this is one thing they can remember you through, right? So that's huge.
Yeah, absolutely.
If the listeners want to learn more about you, how can they get in touch with you? They want to learn about Search for Water, or just understand more about your real estate investment, or how they can utilize your education. Where can they find you?
Yeah, so you can go to our website, casmoncapital.com, has a lot of information as far as the real estate stuff goes. If you want to talk to me about Search for Water, or just, have questions or anything like that, just shoot me an email, john@casmoncapital.com. I'm on Instagram, Facebook, Twitter, @jcasmon on most of those. So just hit me up.
Sounds good, man. Well, hey, really appreciate you being here, kind of going over your story on how you went from a duplex to where you're at now in assets. And really just talking about multifamily and why they're so important, why they're such a good investment, and something that, most people can get involved with. I think that's another thing that people don't quite understand is how easy it is to be involved in one of these deals.
Absolutely.
And so I'm sure that you, or if any of the listeners out there want to learn more, you can reach out to either one of us and be happy to tell you, how just the general normal person can get a piece of an apartment complex. Right?
Yeah, and Scott, can I just make one last point on that before we wrap here? I think one thing, you mentioned you built up a single family portfolio, right? And you had a nice business model going there. And the thing that I really love about multifamily is the professionalism. And what I mean by that is, when we did some single family projects on our own, we had contractor issues. We had a lot of different challenges. It was going with, and you're right, you get it right. I'm not the only person that has had contractor issues, right? So, but I think when you're talking about larger properties, you're dealing with professional companies who this is what they do. When you're dealing with a single family flip, on the other hand, you're dealing with the guy who will do this until he gets another job or something different, and I'll change it in my LLC and go do something else, right? So I just think the professionals with the property management company, with the lenders, you've got folks who have millions of dollars on the line who are vetting this deal, who are making sure everything is good, everything is tight. So it's very different. It's just a much higher level of professionalism and operations. And like I said, for myself, coming from a corporate America, working at a place like General Motors, where I oversaw hundreds of millions of dollars in advertising budget, that's what I was more used to. If you tell me you're going to do something, you do it. And I did one flip that went just horribly wrong. And part of it was the guy told me he was going to do something, and my dumbass actually expected him to do it. So, that's where I think that's the one big beauty for me, at least for myself. I love apartment buildings because you're now dealing with professional folks who, when they tell you they're going to do something, they either do it, or at least there's some accountability there that I didn't quite see in my own experience when it came to single family investing.
Right. Yeah, I think you're completely right, John, and I really appreciate you being here today. The listeners, I'm sure, got a ton of value out of this, and look forward to staying in touch.
Absolutely, Scott. Thanks for having me on, man. #invest this.
That's it. Talk to you soon. Thanks.